from your perspective, tell us a little bit about the financing side.
Yeah, the nice part about ESOPs when you transition is there's a lot of options around financing. The first option would be the seller could finance 100% of the business. Typically, there's a lower interest rate on that note to make it cash flow positive for the company. So typically it's 4 or 5%, and then they receive a warrant on the transaction to reward them for taking a below market interest rate, and then that warrant pays out when the seller debt's paid off. So that's the 100%. Like Tom said, you typically don't see 100% bank financed transactions just because there's not a lot of banks that are going to finance 100% of that airball. So typically we see 25 to 75%, 25% senior debt, 75% seller debt. Seller still takes warrants on it. I encourage companies to take on some senior debt. One, it gets a liquidity event for the selling shareholder, so at least they get something on day one. Two, we're in a really low interest rate environment, so lock in that interest rate. But because of that tax savings, typically that first 25% of senior debt is paid off in 3.5 years. So having an ESOP lender who understands that, no personal guarantees, no prepayment penalties, covenants become a really important part when you talk about senior debt because you're doing 100% redemption. On day one, you're going to have significant negative equity. So if you have a debt to equity or a debt service ratio, that's going to be affected. So working with a bank who understands that and can model out those covenants post transaction. And then what happens is if you pay that 25% off of the first 3.5 years, then what happens is you go back to the debt and take out the next chunk of senior debt, and then you pay that off in 3.5 years. So most selling shareholders are paid out within 7 to 10 years at maximum, typically earlier.